Okay, picture this. After your evaluation of a trading chart, you've laid out a trade plan for a particular market state and a trading position. You're not a trader that listens to outside sources nor are influenced by actions by other traders as seen on the chart that go against your trading plan. As a matter of fact, you sometimes laugh when you see that chart action that shows some traders are taking positions that you consider a sucker's bet. That is the wrong reaction. Instead, you should be silently thanking them for their errors because it is their errors that can quickly power your trade to profit. Have you ever stood in the ocean a few feet from the shore and felt the water draw back into the vastness behind you? Soon you're standing there in water about half of what was there before. Suddenly the water rushes in behind you and it tosses you forward to the shore. That is like those traders that have to exit positions because they are on the wrong side of the market. Their action can actually push your trading position to profits. It's like the trader who sees the bigger moves starting to occur and not wanting to be trapped out of the market, use a market order to get in a trade. If enough contracts are being exchanged, late buyers can also slam price in your direction. Now I want to show you a recent example of what happens when traders get stuck on the wrong side of the market. This chart here shows a small range within a range and what appears to be a momentum break to the downside. Traders were drawn in by the break of the support of the smaller range and of the bigger range. In 13 seconds, price recovers back inside the range and a long trade is eventually taken. 8 seconds later, with the long fueled by shorts trapped in the wrong direction, exiting their position through buying, price flies to the scale out target for half of the overall position. As well, this sudden increase in upwards momentum would have a lot of sideline traders buying in, which just adds the juice to the position that you are already in. This graphic here is 1 minute after the move on that first chart that I showed. You can see price recovered strongly and even broke above what was potentially resistance. Around these areas, you will have breakout traders as well as those looking to fade the breaks of potential support and resistance. Depending on your read of the market and the resulting move of the market, these traders will also add fuel to the move in your direction. Now, just shy of the 3-minute mark from the break below support, you can see that decent profits are about to be taken on the long trade on the final portion of the position. Like that rush of water when the waves crash to the shore, trapped traders can cause quite an aggressive move in the market. Trapped in the wrong direction, fear of losing money. Trapped out of a move, fear of missing the move. That fear and the actions that result can make for extremely pain-free trades for you. The key, as usual, is the ability to read price action and resulting structure. There are almost always clues to where you should be leaning, and your job is to ensure you're looking at the most probable move. Trading around ranges can be pretty tricky. However, know that there will be traders who want to play the break of every potential support and resistance zone. Quite often, the break fails. These traders are trapped on the wrong side with only one play: exit through buying or selling their position. The action that these traders take can result in a more robust move in the opposite direction, causing sideliners to jump in when they see big red and green candles. Like the trades shown on these charts, being positioned already in the probable move can have you hitting price targets rather quickly. You can be well rewarded if you add the reality of trapped traders to your toolbox. One of the simplest ways I know of is if a breakout occurs, number 1, watch how strong people buy or sell on the move. Number 2, when price enters back into the range, consider trading the move back inside. Number 3, allow those trapped to exit to fuel the move and scalp out some profits. It's extremely important to know when you're wrong. Going back to our second chart, let's show a few stop areas to consider. The stop at number 1, it's an obvious area that if breached, the short would probably continue, and that makes a pretty decent exit here. The number 2 stop is in the area of the smaller range, and the auto stop I use just happened to find itself in this region. If that area breached, I could be facing an extension of the smaller range or a complete failure of the upside move. Either one gives me enough reason to get out of the trade. If my trade selection is right, I fully expect price to continue strong to the upside and not find itself pausing in these types of areas. It takes practice, it takes time. But I believe that as a trader, opening yourself to the actual realities, the actual price moves around structure and structure itself is a tremendous course of study.